Are you a real estate investor who's confused whether to invest your hard earned money in Canada or in Dubai? Does zero tax rate and investor friendly environment of Dubai excite you, but you're not clear what your investment strategy should look like in 2026? Today, I'm cutting through the noise, and with data driven insights and practical recommendations, I will help you grow your wealth with minimal risk. So, let's jump in. To understand the property market, you have to look at the engine driving the economy. In 2026, Dubai is demonstrating superior economic momentum with projected GDP growth of 4.5%. This is fueled mainly by non oil sector expansion. Meanwhile, in Canada, you see a subdued 0.9% growth rate, which is hamstrung by trade tensions and demographic headwinds. Looking at the fiscal health, the UAE maintains a fiscal surplus of 3.4%, while Canada is grappling with 2.9% deficit. Dubai has lower unemployment rate of 2.5% versus Canada's 6.8% and lower inflation of 1.8% versus Canada's 2.3%. This suggests a more robust environment in Dubai for immediate growth. Now let's look at the supply and demand drivers for these markets. Dubai is targeting 1 million new residents by 2030. This will require around 50,000 new units annually. This is supercharged by the Golden Visa policy, which attracts high net worth individuals who come to Dubai with a lot of money. Meanwhile, Canada is seeing a 50% decline in land sales due to high costs and slight 0.1% population decline because of the shifting immigration targets. On one side, you see Dubai, which is attracting wealthy residents and wealth from across the globe, whereas you see Canada, that is facing construction and population hurdles. Now, let's look at the bottom line. That means your return on investment. If you're hunting down for cash flow, Dubai is the clear winner. It offers gross rental yields of 6.76% compared to Canada's compressed 3.5 to 4.5%. When you strip away those costs, Dubai's net yield sits around 4.5 to 5.5%, while Canada will give you net returns of around 2.5%. In terms of price appreciation, the gap widens. Dubai's property prices are expected to appreciate by 4 to 7% annually. Canada, on the other hand, is seeing a very modest 1% national average growth. However, there is a catch. Dubai's growth comes with higher volatility profile, whereas in Canada, the growth is low, but the price that you're paying for that is extreme stability. Now, asset selection is another major aspect to understand here because not all markets are equal and real estate is always local. You cannot pick just a country, you have to pick a sub market that is bucking the national trend. If you look at Dubai, the prime villas are the stars due to their limited supply, followed by premium apartments. In Canada, on the other hand, the major hubs are cooling. Toronto is down 4.5% and Vancouver is down by 3.5%. If you want to grow in Canada, look at secondary markets such as Quebec City, which is surging with an expected 12% growth rate due to the affordability advantage. Now, every investment comes with a risk, right? For Dubai, the risk is volatility because the market faces a 15% price correction risk at the moment. There is a potential oversupply with over 150,000 units launched recently in 2025. There's also a moderate geopolitical risk due to the regional tensions in that area. For Canada, the risk is liquidity and stagnation. While the market is safer, the returns are lower and government intervention in the housing market remains a constant variable. So if we compare Dubai versus Canada, Dubai investors must manage oversupply and volatility risk, whereas for Canadians, investor investors needs to manage regulatory complexity along with the stagnation that exists in the market. Now, if you are a Canadian resident or a foreign resident like me, there is a harsh reality or a critical reality that you need to face. While Dubai charges 0% capital gains tax locally, Canada taxes your worldwide income. So, what does that mean? If you sell your Dubai property at a profit of 50%, that gain is included in your taxable income and taxed at your marginal rate. Transparency in Canada is mandatory. If your Dubai property costs more than $100,000, you must file the form T1135, and it's filed annually or filled annually. Furthermore, you must calculate gains in Canadian dollars using the exchange rate from specific dates of both purchase and sale. So, for Canadian investors, foreign exchange hedging is highly recommended to protect yourself against Canadian or dirham fluctuations. So, looking at both these markets side by side for a comparison, let's take a prime segment property. In base case scenario, a Dubai Marina property will deliver around 6.5% net yield, while a comparable Toronto property, the yield will be around 2.2%. Even the moderate shocks of rent or interest rate will not lower down Dubai's yields, and Dubai yields will still remain significantly more resilient. However, for Canada, the yields would be much lower. So, in all, if we compare these two markets, you can clearly see that Dubai offers a significantly higher yield at after you factor in all operating costs in the market. So here you can see that we have scored these two markets across 8 criteria, and the outcome is a tie. Dubai is excelling in return and tax efficiency, while Canada wins on risk, transparency, and foreign exchange stability. Your decision depends on whether you value tax efficiency of Dubai or market transparency of Canada. And ultimately, it all comes down to the type of investor you are. So choose Dubai if you want high yields, tax free income, and have a medium term horizon of 3 to 7 years. In that case, focus on prime villas or premium apartments where the supply is limited and the demand is high. For Canada, you should choose Canada if you prioritize capital preservation and want a 5 to 10 plus year long investment. Look forward towards, or your focus in that case should be purpose built rentals in secondary markets such as Montreal or Quebec City. So, my recommendation for most, the answer isn't either or, it's both. I recommend a hybrid approach. Allocate 60% to Canadian purpose built rentals for stability and 40% to Dubai's prime villas or premium apartment segments for yield. This strategy captures the high yield growth that comes from Dubai while anchoring your capital in transparent legal framework. Diversification is the strongest play for you in 2026, and you have to come up with the right balance for yourself. On this slide, you see a summary scorecard that rates Dubai and Canada on parameters we covered in this video. For your easy reference, you can always refer to these, and this will help you in deciding which of these factors are more important for you, which country rates where, and accordingly, you can diversify or you can adjust your portfolio mix. So, what's my final verdict? To sum up, I'll say Dubai definitely has stronger fundamentals and yield potential. So, you treat it like a high yield asset class in your portfolio, not like a tax loophole. A balanced portfolio should contain assets that offer high yield potential along with assets that give you wealth preservation. The right mix is always the key. Every investor is different. For you, the mix might be different. You might want to focus on high yield more compared to wealth preservation. It depends on your age and other risk taking appetite, but you definitely need to have a combination of both these asset classes to diversify your risk. Also, one very important call out, Make sure to consult a cross-border tax specialist before acquiring foreign assets to make sure you are always making a right, informed decision. So, with that, I would say that was all for today. The world of real estate is changing, whether you choose the desert or the great north. The key is always in the balance. Thank you for watching and hit the subscribe button for more informative videos.